Welcome, beautiful traders, in this awesome video. So I'm just going to be sharing with you simple ways or just an approach that will make you to understand how to enter and when to enter the market when it comes to volatility indices. So I hope this video will be helpful. Just before I can get started, will you please help the channel by hitting that like button, and if you are not a subscriber, just make sure that you are a subscribed member, because we post videos frequently that are here to improve and develop your trading. So what you need to understand is that I've been teaching you guys about different entry techniques, more especially in a lot of videos, even if the video is not for entries, but I do sometimes mention how to enter your market. For an example, I've been mentioning things like pattern breaks. Let me just pattern breaks, and also I've been mentioning a lot of things like considering even momentum when you are entering your trades. So it's a lot of things that I've been mentioning, but here I just want to clarify on how to enter from a pattern break or from a consolidation, how to enter if the market has been in such a mode or it has been in such a range. How do you really go about that? So we are just going to look just few example in this chart here, this volatility 75 index chart. So we're just going to look some few example here. So we can see here we had this kind of a ranging market here. So if there is a ranging market, you need to know that that's where we spoke about transition, where there is a dealership or where there is negotiation, and you need to know that after that the price will take direction, just as it did from the breakout of this level here. It went down. So the question is, how do you know when the market is now ready to make a move? So there are different scenarios of the market. So we're just going to use this one, and then that third one. So it's different. For an example here, you can see that it's just a smooth range. There are no complications. You can just put it in a box like this. There are no complication. There is nowhere where something can be faked. For an example, if you are going to consider this high here as a false breakout, then you really have to spend your time in checking breakouts, because here, remember what we spoke about is that highs and lows or support and resistance is not a line just as I've drawn here, but it's something like a zone. It's a zone or a region, something like this. So you can't say this was a false breakout, because still the price is around that same level. The price still around that previous price. So you have to focus also on that, because a lot of people say this was a false breakout, this was also a false breakout. No, it was not. It's not like that. Price is still around that zone. So it's still when price have went a bit far that we can call it just a breakout or a false breakout. For an example, if price went up and bounced somewhere there and came back, we're going to call that a breakout, because it is not way close to any high or any low. Here, the reason we say this is not a false breakout, it is because here you can see that price is still in the borders of this, even that wick there, that tail there. So it's still around that price is still around that price. Even same thing applies here. We're expecting price to react here. Why? Because we also have some key levels before, something like this. So we can't say I sold here thinking that's the breakout. No, you have to understand what happens in breakout. So it can happen that the price is in a smooth range like this. When it is in a smooth range like this, it is easy for you to enter the trade. Why? Because you are going to consider just a breakout of that smooth range. For an example, we can connect our lows here and we can connect our highs, something like this. So when price really goes far out of these lines, then it's your entry. But then now the question is, what if now there is market activation? Because remember, I talked about market activation, that there is a transition, and then there is market activation, and then there is the actual direction. So that's what happened here. That's what happened here. There is this transition here, or this market inactivity here, and all of a sudden there is this bridge which goes up. A lot of people can think that, wow, this was a corrective and then it's a continuation of the bias. But we need to understand when it comes to market activity. So here is a simple a trick that is going to help you. The reason we cannot say this was an impulsive wave after a corrective, it is because of the change in the market structure or in the behavior of the wave, because looking at the previous waves here, you can see how smooth or how aggressive the price was going up. You can see how smooth and aggressive the price was going up, and all of a sudden price, it corrects here. It even corrects more than it did before, because here is a small corrective and all of a sudden a bigger corrective. So these should also raise questions to you that how can my corrective be bigger than the previous one? Because if it is bigger than the previous one, it means that someone else, for an example in this case the sellers, are getting in the market. So it means that the sellers are now getting in the market. Why? Because I'm having a bigger corrective. So after this bigger corrective, let's say a lot of traders ignore it. Just as they ignore it, they say no, this one is a corrective. They forget about that corrective here, this red one. They say this is my corrective, and when it resumes going up, they say it's a continuation of this guy. If it's a continuation of this guy, we need to see the smoothness of this guy. We need to see the flow. So here there is no flow, there is just struggling. So if there is struggling, it means that it's in transition. It's still a negotiation between the buyers and the sellers, because it's buyers and then boom, a seller is coming in. And then here they are fighting the price. Who is taking the price now? Who is taking the market? Is it the seller or is it the buyer? So when you see this and then boom, something like this happens, you shouldn't be in a rush to take decision. You should be in a rush to take decision, because a lot of people, they say, Pti Forex has taught us that after in transition, or he has taught us about pattern breaks, that if the price was in a pattern and then when the pattern is broken, we should enter. So a lot of people can say, okay, here is a pattern, it was broken here, I am buying here. But then how can you buy when this record is not broken? How can you buy when this record is not broken? So, and what you have to keep in mind, remember here we are waiting to see the sellers coming in just as they came in with this corrective here. So we are waiting for them to confirm if they are really inside the market, because here they gave us a lower high. A lower low. Here is a low and then it's a lower low. So we are waiting for them. Are they really coming in, or they were just joking with us? So that's why we cannot rush to take decisions, because you need to understand that here it's an up move about to shift in a down move. So we don't just play around like we are doing when we are trading just a downtrend or an uptrend. Here it's a reversal. You see, it's a reversal from this upward move to another one. So that's where we need to wait, because in most of the cases there is market activation where the traders are activated after a small delay, no matter the time frame. So here when we saw this was like market activation, and all of a sudden the market came back. That's why a lot of people, they call it false breakout. That's where the market activates a lot of buyers, because after this move there are a lot of people saying I'm buying. So traders were back in the game, and then the market was active, and then it has to take its direction. That's why it went back down just after it touches this level here. It went back down into this same zone that we're escaping, and then all of a sudden that's where you should expect a significant move after the market was activated. Usually after market activation, the market will always take direction, it will not delay. So that's why you should be expecting a move. And then when you see a breakout of these lows, and also here there is some kind of a delay, which can be a small retest, that's when you say, now I can take a decision and sell after a close of this red candle, because now it is clear I'm not close to any significant level here. There is nothing that happened here, so it is all clear. I am ready to go. You see, then you can sell your asset or whatever. You see, so that's what you should understand as a trader. The market will always activate the traders after a delay. In most of the cases it will do like that. It will always break and then come back quickly and then continues again. This was the same thing that happened here. It was just a small delay and all of a sudden a breakout here. If you are not wise, because the reason the market does this, it is because always traders or retail traders will enter late. There are few people who bought it here after the breakout. There are also few people who bought it here after the retest, but a lot of people were buying here. A lot of people were buying here. That's why it will always do this and then come back quickly to deal with the guys who entered late. You see, that's why it came back quickly in this same zone and then it went all the way up taking direction. So it was a pause or in transition, and then market activation, and then it went all the way to its direction that it wanted to go. So you should be careful of these things, guys, when you are entering your market. Don't just take decisions quickly. Understand the flow, understand the price, understand the transitions, understand false breakouts and everything. That is going to improve your trading. So thank you for watching this video.